Welcome to The Explainer. Today we're demystifying what is literally the lifeblood of any business, cash flow. We'll be diving straight into a really fascinating piece of source material called Insight into Cash Flow Management. We're going to uncover exactly why some massively profitable companies still end up going bankrupt and how mastering the timing of your money is the real secret to financial survival.
Okay, let's dive into this and look at the agenda. We've got 5 distinct sections to help us truly understand business liquidity. We'll start with the profit illusion, move on to the 3 cash flows, explore the working capital trap, look into forecasting your future, and wrap up with a 7-step survival guide. Kicking things off with Section 1, the profit illusion. Because as it turns out, profit absolutely does not equal cash in the bank. The source text hits us with a pretty startling paradox right out of the gate. A company can report these massive, incredible profits, yet still face total financial ruin if they don't have the actual cash on hand to pay their bills. It's the ultimate business irony, right? It's like dying of thirst while swimming in an ocean of theoretical money. Imagine your company books a $1 million sale today on 30-day credit terms. Under standard accounting rules, boom, you recognize that $1 million in revenue immediately. You look incredibly profitable on paper. But here's the harsh reality setting up our high stakes. You've received 0 actual dollars today. Meanwhile, your employees still expect their paychecks, your landlord wants the rent, and the utility bills are due right now. This creates what the text calls a very dangerous liquidity gap. And that liquidity gap is exactly why management has to actively monitor 2 entirely separate things. You can't just look at profit alone. You have to combine profitability with actual liquidity, the real cash moving in and out to achieve true long-term financial sustainability. A profitable company experiencing a cash shortage is, make no mistake, a company in extreme distress.
Moving to Section 2, the 3 cash flows. We really need to figure out where exactly is the money moving. To prevent those cash shortages, our source material divides cash into 3 distinct buckets so we can trace its exact journey. The first, and honestly most critical bucket, is operating cash flow. This is the cash generated or used by your core day-to-day business operations. Think customer collections or paying your suppliers. This is absolutely crucial because it acts as the ultimate stress test. It tells you whether your core business engine can actually generate cash on its own without needing a lifeline from the outside.
Next up is investing cash flow. This tracks the cash related to long-term asset investments, so purchasing property, upgrading a warehouse, things like that. Now, a really important note here, seeing a negative number in this bucket isn't always a bad sign. Actually, rapidly growing businesses often run negative here because they are intentionally investing heavily into their future capacity.
The third and final bucket is financing cash flow. This covers cash related to raising and returning capital. We're talking about issuing shares, taking out loans, or paying dividends. It defines exactly how the business is funded and how it handles returning that capital to its investors.
All right, Section 3, the working capital trap. This is what happens when cash gets stuck in the gears.
Now, what's really interesting about this slide is how it introduces us to the cash conversion cycle, or CCC. Working capital can easily become a trap if your cash gets tied up in inventory or slow-paying customers. So the CCC measures that friction using 3 time-based variables: days inventory outstanding, days sales outstanding, and days payable outstanding. Basically, it tracks the exact number of days it takes to turn the cash you invest into your operations back into cash received from your customers.
Let's walk through a specific math example right from the text to see how this trap actually snaps shut. Imagine your inventory sits unsold for 45 days. Then, once you finally sell it, your customers take 40 days to pay you. That's 85 days your cash is just out of your hands. Thankfully, your suppliers give you 30 days to pay them, which acts as a slight buffer. So 45 plus 40 minus 30 leaves us with a cash conversion cycle of 55 days. That means for 55 straight days, your operating cash is dangerously tied up. You have to find a way to fund your business for almost 2 months while waiting for that cash to return. It's literally like trying to hold your breath underwater for way too long.
Let's look at the solution in Section 4, forecasting your future. This is all about seeing around those financial corners.
So how do we actually survive that trap? According to our source material, forecasting is honestly one of the absolute most powerful tools management can use to predict and avoid these liquidity gaps entirely. But you can't just rely on one static forecast. To plan for absolute survival, you have to model 3 distinct scenarios. You need a base case for your most realistic expectation. You need an optimistic case, which factors in higher sales and faster collections. And critically, you must have a downside case,
where sales drop, costs go up, and customers take their sweet time paying you.
Running these models forces you to ask some really tough what-if questions, like what happens if sales suddenly decline by 20%? Or what if our biggest customers decide to pay us 30 days later than usual? Asking these vital questions helps you determine exactly how much of a cash reserve you need to have on hand to survive a sudden, unexpected downturn. Which brings us to our final section. Section 5, the 7-Step Survival Guide. A highly practical framework for cash management. So, the crucial point is how the source material brings all these theories together into an actionable daily plan. It starts with aggressively diagnosing and tuning up the cash flow engine. Step 1, measure your exact current balances. Step 2, forecast your short and medium-term timelines. Step 3, identify the exact gaps where cash shortages might happen. And Step 4, optimize your working capital so that cash doesn't stay trapped in the cycle.
Let's move to and see how this builds into long-term defense. Step 5 is to control spending, making sure you prioritize strategic expenditures. Step 6 is to maintain that liquidity backup we talked about. And Step 7, which might just be the most important part of the whole shebang, monitor continuously. You constantly have to compare your actual numbers against your original assumptions.
As we bring this explainer to a close, we realize there's a massive shift in mindset required here. Successful management moves way past simply asking, how much profit are we making? To truly survive, you have to aggressively ask this specific timing question. When exactly will we receive the cash?
And then you have to immediately follow that up with, when will we need to pay it? Answering these two questions systematically is exactly what reduces your financial risk and creates a highly resilient business. I want to leave you with a really powerful quote, straight from the text. Cash flow management is not just about controlling cash. It is about controlling the financial timing of the entire business. That is the ultimate takeaway here. Are you just counting your theoretical profits, or are you truly mastering the element of time in your business? Until next time, keep learning, keep forecasting, and stay focused.